The market is currently closed, so we must look to the last trading session for a clear picture of Apple, AAPL, and its trajectory, which saw the stock close at 271.40 on Thursday, October 30th, 2025, after a slight rise of 170 or 0.63% on the day. Now, the common expectation is that Apple is the ultimate safe harbor, the stock you buy and forget, perpetually printing cash due to its massive install base and services revenue. But here's the critical angle many are missing right now. The recent surge that pushed its valuation past the $4 trillion mark was not solely an endorsement of its current financial performance. It was a preemptive bid on a delayed artificial intelligence strategy that the market desperately wants to see materialize immediately. An expectation that has now created a tight tension with the reality of the company's stated development timeline. This post-earnings move, despite a dip earlier in the week following the broader tech sector's volatility, really highlights that investors are pricing in future growth on a core technology that Apple has been notably cautious about, an interesting dynamic for a company built on iterating on consumer electronics. The market narrative says Apple is invincible, yet the truth is that the stock's most recent spike is predicated on the belief that it can quickly catch up to its competitors who are already aggressively monetizing large language models and other forms of generative AI. The daily price action for Apple has been choppy, which is to be expected following a massive earnings week for the entire Magnificent Seven cohort. Despite the volatility, AAPL's volume remained robust at around 86 million shares on the last session, well above its 54 million average volume, indicating significant institutional activity and rebalancing, which is often a sign of funds adjusting their positions following the quarterly results. The earnings report itself was a classic Apple performance, a beat on both the top and bottom lines, with a record $102.5 billion in revenue for the September quarter, driven by a record in services revenue and surprisingly strong demand for the latest iPhone 17 series, particularly in emerging markets like India, where the company hit an all-time revenue record. The immediate price reaction was positive, reinforcing the widely held belief that Apple's consumer loyalty and ecosystem moat are impenetrable. However, if you look closer at the institutional filings, you can see a more nuanced picture. While massive firms like Vanguard and BlackRock are fundamentally buy and hold institutions and hold enormous positions, recent 13F filings, though they only capture positions from the end of the previous quarter, show firms like SMR LLC and even Berkshire Hathaway modestly decreasing their positions in the June quarter, suggesting that even some long-term sophisticated investors were taking some profit off the table or reallocating slightly ahead of the latest earnings cycle. This subtle movement shows not everyone is unanimously bullish at these valuation levels, challenging the pervasive buy-no-matter-what sentiment. Now let's talk about the elephant in the room that the market is watching closely, the short-selling landscape. For a stock with a $4 trillion market capitalization, you might assume short-seller interest is minimal, but you would be mistaken. While the short interest as a percentage of the float is low, sitting around the 0.74% mark according to the latest NASDAQ data, the sheer number of shares shorted is substantial, currently over 109 million shares. The days to cover figure, a metric that indicates how many days of average trading volume it would take for all short sellers to buy back the borrowed shares, is a manageable 3.05. This figure is not high enough to indicate a pressing risk of a massive short squeeze, the kind that ignites massive retail-driven rallies, but it is enough to show there is a consistent, sophisticated short thesis at play. The rationale from these short positions is typically centered on valuation, arguing that the stock's current multiple is too rich for a hardware company that is experiencing low single-digit growth in its primary product, the iPhone, and that its reliance on continued China sales is a massive geopolitical risk. The short borrow fee rates for APL are currently very low, sitting around 0.25%, which is typical for a stock with such high liquidity and availability for borrowing, so there is no immediate cost pressure on the short sellers to cover their positions. We have not seen any major named short reports against Apple recently, unlike some of its peers, but the underlying institutional shorting is consistent. To monitor this, retail investors should track the short interest data published mid-month and at the end of the month, which is available on NASDAQ's website. A sustained and rapid increase in the short interest percentage, even with low borrow fees, would signal that professional bearish sentiment is growing. For now, the short activity acts as a slight headwind, a constant trickle of selling pressure, not a massive catalyst. What's your take on the rising short interest, even if it is a small percentage of the float? Smart money or manipulation? Comment below how many shares of Apple, AAPL, you currently hold. It's interesting to see where the conviction lies in the retail world. Delving into the company's actual operations beyond the stock chart, the bedrock of Apple's success remains its tightly controlled business model, which centers on the seamless integration of proprietary hardware, software, and services. The iPhone segment still accounts for the lion's share of revenue and profit, but the high-margin services division, encompassing the App Store, Apple Music, iCloud, and Apple Pay, is the key growth engine, consistently posting double-digit percentage increases in revenue and providing a highly predictable recurring revenue stream. This service moat is the primary reason why analysts have been willing to afford the stock a premium valuation for so long. The debate over its hardware business is valid, though. The reality is that the new iPhone's features, while well-received, often feel incremental, leading to what is commonly referred to as the sell-the-new syndrome after product launch events. Yet the strength in emerging markets, as highlighted by the CEO's comments on India, demonstrates that the company still has significant geographical penetration left to execute, something that balances out saturation concerns in mature markets like the US and Europe. The older reports show a history of successful navigation through cyclical hardware demand by leading on the stability of services revenue and a massive loyal user base. The future outlook for Apple is all about the expectation versus reality tightrope walk around new growth drivers. The expectation is that Apple will eventually produce a blockbuster new product category following the success of the iPhone, or that their delayed artificial intelligence suite, Apple Intelligence, will instantly vault them past the competition. The reality is much more complex and drawn out. The company is reportedly pursuing tie-ups with Alphabet's Gemini, Anthropic, and OpenAI, which speaks to a realization that they may need external help to quickly deploy a best-in-class generative AI capability. CEO Tim Cook acknowledged that major updates to Siri and the full AI suite won't arrive until next year, potentially spring 2026, which is a significant delay and a point of tension for the stock. This timeline directly contradicts the market's expectation for immediate AI integration, creating a potential headwind if other large tech players can successfully monetize their AI offerings in the interim. The other major opportunity is their expansion into new markets, especially in Asia, where the company is not only seeing sales growth, but also actively diversifying its supply chain away from an over-reliance on a single country, a move designed to mitigate geopolitical risk, which is a significant quiet positive for the long-term risk profile. On the risk side, besides the China reliance and the delayed AI strategy, the regulatory pressure across multiple jurisdictions, particularly related to the App Store Commission and dominance, is a genuine threat that could chip away at the services segment's profitability, which is the stock's highest valuation multiple. Any adverse ruling or legislation could force a business model adjustment that hits earnings. Looking ahead, investors should monitor the quarterly guidance for the crucial holiday season, specifically looking for any commentary on supply chain constraints and continued strength in services gross margins. The key catalyst will be the first public demonstration and concrete timeline for the Apple Intelligence suite. If the demonstration is compelling and demonstrates a genuine proprietary capability, the stock has the potential for another leg up, as the market's initial high expectations are exceeded. If it falls short or is further delayed, the stock could face pressure as the reality of its cautious development strategy sinks in. The overarching theme for Apple right now is that the stock's premium valuation is no longer just for its current cash generation, but for the belief in its future ability to dominate the next technological wave, a future that is still very much in development. The tension between its secure, high-margin present and its uncertain, high-potential future is what makes the stock so fascinating to watch right now.